Welcome back to the Deep Dive. Today, we are not just looking at a quarterly earnings report. We're looking at a verdict.
That is exactly what this is, a verdict.
So yesterday, January 28th, 2026, Microsoft dropped their Q2 results for fiscal year 2026. And usually, let's be honest, we skim these, we look for the revenue beat, check the guidance, and move on. But this one feels different.
It really is. Because for the last, 2 years, the entire tech industry and frankly the stock market has been kind of holding its breath.
Right.
Everyone's asking the same question. Is this massive, trillion-dollar bet on AI actually going to turn into real money, or is it just a very, very expensive science project?
Exactly. We've seen the demos, we've used the chatbots, but today we're looking at the scorecard. We have the press release, the financial statements, all the breakdowns right here. And the numbers are, well, they're big, but they're also a little complicated.
They are. I mean, on the surface, it looks like a total victory lap. But when you start digging into the footnotes, especially around a certain partner, OpenAI, and the sheer amount of cash they're burning on infrastructure, the story gets much more nuanced.
So our mission today is to decode that puzzle. We're going to strip away the PR and figure out what's really happening inside the engine room. Let's start with those headline numbers that hit the wires.
The top line is just undeniable. Revenue came in at $81.3 billion. That's up 17%.
And just to put that in context, growing 17% when you are already that big is incredibly difficult. That's the law of large numbers working against you.
And they're defying it. Operating income is also up 21% to $38.3 billion. But the number that probably made you and every analyst do a double take was the net income.
This was the shocker. GAAP net income was reported at $38.5 billion. That is a 60% increase year over year.
60%.
Now, I have to play devil's advocate here. A company of Microsoft's size doesn't just accidentally grow profits by 60% in 3 months because they sold a few more copies of Windows.
Yeah.
That feels artificial.
You are spot on to be skeptical. And this is where we have to put on our forensic accountant hats. Because that 60% number, it's real, but it comes with a massive asterisk.
Okay, walk us through the asterisk.
If you scroll down to the non-GAAP definition section, the boring part everyone skips, you find the culprit. It's labeled impact from investments in OpenAI.
The ChatGPT creators.
Precisely. Microsoft owns a huge stake in them. Now, accounting rules for these kinds of investments can be volatile. And in this quarter, Q2 2026, Microsoft recorded a net gain of $7.6 billion from that investment.
Wait, I want to be crystal clear. When you say a gain, did OpenAI write them a check? Is that cash in the bank?
No, and that is the critical distinction. It is a paper gain. It's an accounting recognition that the value of their stake has gone up. It hits the net income line, but it doesn't mean they have that cash to spend on payroll.
Okay, so that inflates the profit number. Significant.
Very significantly. And to understand why the percentage growth looks so crazy, that 60%, you have to look at what happened 1 year ago. In Q2 2025, they actually recorded a loss of almost $1 billion on that same investment.
Ah, I see. So the math is comparing a nearly $1 billion loss last year to a $7.6 billion gain this year. That's an $8.5 billion swing.
Exactly. Just from one line item, it supercharges their GAAP earnings per share to $5.16.
So if we strip out that OpenAI anomaly, what does the real business growth look like?
Still very impressive. The non-GAAP net income was up 23%.
Which, to be fair, is still extremely healthy.
It's incredibly healthy. It tells us the core business is firing on all cylinders. But that headline, the 60% profit explosion, that's the investment portfolio acting like a turbocharger.
So the aha moment here is business is booming, but the record-breaking profit is partially an accounting reality based on OpenAI's valuation.
Accounting reality versus cash reality is the right way to think about it. But look, we can't let that distract us from the real engine here, because the money they are making from selling actual products, specifically the cloud, is arguably even more important.
Right, let's talk about that engine room.
Yeah.
The cloud. In the report, they use this metric, Microsoft Cloud Revenue.
Right. This is their way of bundling everything, commercial Azure, Office 365, all of it into one giant number to show their scale.
And Amy Hood, the CFO, she said Microsoft Cloud Revenue crossed $50 billion this quarter, $51.5 billion, up 26%.
Just pause on that for a second. $50 billion in one quarter. That's an annualized run rate of $200 billion. just from the cloud. That's larger than the GDP of entire countries.
It's mind-boggling. But I want to drill down into the intelligent cloud segment. This is where Azure lives, right? The back-end infrastructure.
This is the heart of the beast. Segment revenue here was $32.9 billion, up 29%. But the number everyone watches, the one that drives the stock, is Azure.
And Azure and other cloud services grew 39%.
39%.
I remember a few years ago, analysts were saying that as Azure got bigger, that growth would have to slow down, the law of large numbers again. But this feels like an acceleration. What's driving it?
It connects directly to what Satya Nadella said in the release. He said, "We are only at the beginning phases of AI diffusion."
AI diffusion. What does he actually mean by that?
He means that AI isn't just a chatbot anymore. It's diffusing. It's spreading into the plumbing of every company. When Azure grows 39%, it means companies aren't just storing data. They are renting the GPUs to run their own AI models. They're building on Microsoft's AI stack.
So this confirms it. Companies have moved past the kicking the tires phase with AI.
Absolutely. You don't get 39% growth on a base that huge from pilot projects. This is deployment. This is real.
It's like they've become the electric utility. If AI is the new electricity, Azure is the grid.
That is the perfect analogy, and everyone is plugging in. But that diffusion isn't just in the back end, it's bleeding into the software we use every single day.
Right, let's move to productivity and business processes. This is Word, Excel, LinkedIn, Dynamics.
And the segment brought in $34.1 billion, up a very solid 16%.
But I want to look at the breakdown because there's a surprise in here. Dynamics 365, their Salesforce competitor, up 19%. Office 365 Commercial, up 17%. LinkedIn, up 11%, all good. But here's the one that made me blink. Microsoft 365 consumer revenue is up 29%.
That is fascinating, isn't it?
It is. I mean, usually we're talking about big enterprise contracts.
Yeah.
But the consumer side, just regular people at home, is growing faster percentage-wise. Why?
I think we're seeing the co-pilot effect.
You think people are actually paying extra for the AI assistants at home?
Think about it. For years, an Office subscription for a consumer was a grudge purchase. You bought it because you had to. But now, with Copilot, that subscription actually does things for you. It summarizes documents, it drafts your emails.
So it's moved from a simple utility to a genuine productivity booster.
Exactly. And a 29% jump suggests that people are finding enough value there to open their wallets. But there's another number in this section that I think is even more significant. It's a bit technical, but bear with me.
Lay it on us.
It's the commercial remaining performance obligation.
That is a mouthful, in plain English.
It's the backlog. It's money that customers have legally committed to pay in the future through contracts. It's their future income, basically guaranteed.
Okay, I'm looking at the report.
Yep.
It says it increased 110% to $625 billion.
110%.
Wait, hold on. $625 billion.
Yes.
That's more than the GDP of Sweden? They have that much money locked in for the future.
They do. And that number more than doubled in a year. This tells us that the biggest companies in the world aren't just dating Microsoft anymore. They're married. They're signing huge multi-year contracts, locking themselves into the ecosystem.
That is a terrifying moat for a competitor.
Good luck. That $625 billion is a fortress of guaranteed revenue.
So we have the cloud exploding, consumer surprising us, a backlog that secures the future. It sounds perfect, but there's always a but, isn't there? Not everything in this report is a green arrow.
No. And looking at the weak spots is really revealing.
We have to talk about more personal computing. This is Windows, Xbox, Surface laptops.
And it is the clear outlier. Revenue for this segment was $14.3 billion. That is down 3% year over year.
Down 3%. In a quarter where everything else is rocketing up. Let's break it down. Windows, OEM, and devices.
Basically flat, up 1%, but unchanged in constant currency. The PC market isn't crashing, but it's not driving any growth.
And then there's gaming. Xbox content and services.
Decreased by 5%.
Oof, that's gotta hurt. We've heard for years that gaming is the future, the Activision acquisition. But the numbers show a slump.
It's a really stark contrast, isn't it? You have the AI boom driving 39% growth in one corner and a gaming slump in the other.
It feels like a tale of two different companies under one roof.
It really does. I mean, even within this segment, the only real bright spot was search and news advertising, which is basically Bing. That was up 10%.
Which, again, is almost certainly because of the AI integrations.
Exactly. The digital AI-driven bits are growing. the hardware in traditional gaming, shrinking, at least relative to the cloud.
It really feels like the company is shedding its old skin. For decades, Microsoft was Windows. Now that part of the business looks like an afterthought.
Afterthought might be strong, but it's definitely not the engine anymore. The AI utility company is the entity taking over.
But becoming an AI utility isn't cheap,
No, it is excruciatingly expensive.
which is the perfect segue to the money trail. Because you can't build an AI empire on code alone. You need chips, data centers, power.
And if you want to see the real story, the real risk they're taking, you have to look at the cash flow statement under investing activities.
I'm looking at it. The line item, additions to property and equipment, this is their CapEx. They're spending on physical stuff.
Read the number for this quarter.
29.8. So $6 billion.
Almost $30 billion.
In 3 months.
In 3 months.
NASA's entire annual budget is less than that. They spent a NASA budget in 90 days on servers and concrete.
And to really see the acceleration, look at the same quarter last year.
Last year it was $15.8 billion.
So they have nearly doubled their infrastructure spending. They are spending about $10 billion a month building the physical reality of this AI network.
That is just wild. It shows a level of conviction that is almost scary. You don't spend $30 billion in a quarter unless you are absolutely certain the demand is coming.
Or unless you're terrified of falling behind. It's a mix of both. But remember that backlog? That $625 billion?
Right. The invoice of the future.
That backlog justifies the spending. They know the customers have already committed, so they are frantically building the capacity to serve them.
But doesn't that just burn a massive hole in their pocket? I mean, cash flow must be taking a huge hit.
Well, net cash used in investing was over $22 billion. So yes, cash is flying out the door. But here is the sign of just how financially absurd this company is. Despite that historic spending, they still returned $12.7 billion to shareholders.
Wait, so they nearly doubled their infrastructure spend, but they also paid shareholders more? That's up 32% from last year.
It's a flex, a massive financial flex. If you look at their balance sheet, they have nearly $90 billion in cash and short-term investments.
So they have the war chest.
They have a war chest that lets them build the future, pay their shareholders, and still sit on a mountain of cash.
It really paints a picture of a company that is prioritizing, letting the old businesses drift a bit to pour every ounce of fuel into the AI rocket.
That's the key takeaway.
So let's try to summarize this deep dive. We have revenue up big, 17% to over $81 billion. We have that massive 60% jump in GAAP profits.
Largely thanks to that $7.6 billion paper gain from OpenAI, a sign their bet is paying off, in valuation at least.
Right. Then we have the cloud engine, Azure, growing at a blistering 39%, confirming AI demand is real and accelerating.
And we have the productivity side, locking in future revenue with that absolutely insane $625 billion backlog.
But on the other side, we have the drag. The more personal computing segment, Windows and Xbox, is basically stagnant.
Showing us that consumer hardware and gaming are becoming less and less relevant to the company's growth story.
And finally, the spending. A historic $30 billion poured into CapEx in one quarter.
It's a clear signal. They are betting the farm on AI.
It really makes you wonder about the future identity of this company. For decades, their mission was a computer on every desk and in every home.
It was, and they pretty much did it.
But looking at this report, seeing more personal computing shrink while cloud and AI infrastructure becomes this overwhelming engine, are we seeing the end of Microsoft as a consumer brand?
That is the question, isn't it?
Are they evolving into something else? Not a software maker for you and me, but the utility company of the 21st century, the electric grid for the entire AI world.
If you look at where the money is going, that $30 billion in infrastructure, and where the revenue is coming from, the answer seems to be yes. They are building the power plant, and everyone else is just plugging in.
A fascinating thought to leave you with. As you go about your day, using your laptop, maybe playing your Xbox, just remember, for Microsoft, those might just be legacy hobbies now. The real action is in a data center you'll never see, costing billions, powering an intelligence we are just beginning to understand.
It's a brave new world.
It certainly is. Thanks for listening to this deep dive into Microsoft's Q2 2026. Make sure to check the show notes for a link to the full earnings report if you want to crunch the numbers yourself. We'll see you next time.